Hello, good people. So this is financial accounting, and we are going to talk about regulation and other principles guiding the accounting profession. Specifically, this one will be topic two of the financial accounting. So topic two. So we shall talk about the legal sources of the regulations. We shall also talk about the professional sources of regulation. We talk about the ethical requirement. We talk about the accounting standards. Then we talk about the qualities of the financial statement, and then we finalize with the accounting principle, concepts, and basis that are applicable in accounting profession. So welcome to lesson two of the financial accounting. I hope everyone is okay. So let us dive in. Let us dive in and start. So guys, let us dive in legal sources of regulation. So that will be the first subtopic, legal sources of regulation. Legal sources of regulations. So when we talk about the legal sources of regulation, we shall focus uh, we shall focus on the laws which relates to Kenya because we are in Kenya. Now in Kenya, accounting practice is guided by specific laws that provide a framework for preparation, auditing, and auditing of the financial statement. Now, this law promotes accountability and financial discipline in both public and private sectors. So, what you need to know when you talk about the legal sources of regulation in Kenya, which I say that these laws promotes promotes what we call promotes accountability, accountability, and financial discipline, and financial discipline, discipline, discipline in that form in both public and private sector. So when we talk about these legal sources are formulated purposely to promote what we call the accountability. Remember, we are talking about financial accounting. So when we talk about financial accounting, we need to talk about accountability and the discipline when it comes to the financial reporting on financial accounting. Now, the keyword here is that these legal sources are there to promote what we call the financial accountability and financial discipline, uh, not only in public entities but also in private entities or private companies. Now, in Kenya, we can say accounting practice is guided with specific rules or so we can say accounting practices is guided by specific laws. Specific laws. What are those laws? Which provide in Kenya the accounting practice is guided by specific laws, which you can say which by specific law, which provides uh, legal framework for preparation and auditing of financial statements. That one is correct. Now let us see so that some of those laws examples of the legal laws Legal sources of regulation. So before we state them, we are saying that in Kenya, accounting practices is guided by specific laws. Specific laws. So there's these laws that are formulated in order to assist or to promote what we call the accountability and financial discipline in both public and private sector. Now, those laws are there purposely to do all those items that I have just mentioned. Now, we want to see what are some of those examples or some of these sources that we are trying to talk about. Number one, let's talk about company law, Company Act, not Company Law, but rather Company Act of 2015. And to be specific, it is under CAP 486. If you want to go and read it, you can find it under 486. So in this case, it talks about how the company um, this act CAP 486 uh, talked about specifically the regulation of the financial reporting, the regulation of financial reporting. So how the company should report their financial information. So how the company should formulate, should prepare, present, audit their financial statements. So that is all about the CAP 486. So we can say, we can either say this act regulates. So they regulates financial reporting, financial reporting by companies registered, by the company registered in Kenya, and mandate compliance, and mandate compliance. So they mandate compliance uh, with international accounting standards. I would say with international, that's right in full, international accepted accounting policies. So that is the what it, that's about the Company Act of 2015 and the CAP 486, and we are saying that this act, as it is there to regulate what we call the financial reporting. When we talk about financial reporting, is the presentation of the financial statements. So the act, it regulates the financial reporting by the companies registered in Kenya and mandate compliance with international accepted accounting policies. So what they try to say, they ensure that the company reports their financial statements in time, and also they ensure that the company adheres with accounting international accepted accounting policies. For example, like which accounting policy? For example, the IFRS. So they ensure, and IPSAS. Or I will just say IAS. So IFRS is International Financial Reporting Standards. We will talk about this later. We will talk about them later. But the Company Act, apart from regulating the company registered in Kenya in terms of financial reporting or presentation or preparation of the final account and make sure that they report those statements in time, they also ensure that they adhere with international accepted accounting policies. For example, the International Financial Reporting Standards and International Accounting Standards, so that those accounts are prepared in accordance to the international standards or international accounting standards. So, Company Act also makes sure that when the company prepares the financial statement for the purpose of reporting, that those statements are compiled in accordance with the IFRS and IAS. IFRS and IAS. So that's some of the functions of the Company Act when we talk about financial reporting functions. of the Company Act when it comes to the financial reporting. Number one, they requires company to prepare proper books of account. Requires companies to prepare to maintain proper books of account, to maintain proper books of account, proper books of accounts. That's number one. Now, for accounts to be prepared, to have what we call the proper books of account, or for the company to maintain a proper books of account, they need to follow the framework, that is the legal framework that is provided by the Company Act. And one of the legal framework is they should follow the accounting standards when preparing the financial statements. Number B, or number two, provide guidelines. They provide guidelines. They provide guidelines when it comes to the preparation. When it comes to preparation, of the financial statement. Financial statements. So, how do we prepare our financial statement? Which rules should we follow? Which accounting policy, for example, the listed policies, which one should we follow? So they also provide the guidelines on how to prepare the statements and which guidelines should we follow. They also mandate external audit of company account, of the company's accounts. So what does it mean? It means that it is the function of the Company Act Cap 486 to make sure that the companies, the records or the financials of the companies are examined by an external audit, that they are examined by external audit. So they make sure that at the end of the financial year, once the company has reported their financial statement, that those statements will also be overseen by another independent body as an external audit. So it is the mandate of the Company Act to make sure that that there is an external audit who examine the company's account also. Number D, they set timelines. Set timelines for financial statement submission. For financial statement submission. So they are the one who sets the timeline when all the financial statements, be it of a SACCO. So for example, SACCOs, they have their own submission period. Normal companies have their own submission period. Agricultural companies. So they set the timeline when different companies in different sectors should submit their final financial statements to the public or to the relevant authority. Next, they also provide penalties. They provide penalties. They provide penalties for non-compliance. For non-compliance. So they provide penalties for non-compliance with the reporting standards. So they provide penalties for non-compliance. So they provide, when you say they provide penalties for non-compliance, is that they set rules. that should be followed. In case the company do not adhere or do not follow those rules, then there is already penalty that has been set. So every company need to focus on the company act so that they adhere to what we call the compliance aspect, so that they do not they make sure that they comply with the standards which have been set, so as to avoid penalties and something like that. So that is number one. That is number one. We call them the Company Act. Number two is the Income Tax Act. Number two, Income Tax Act. This one is under cap 470. Now we talk about the Income Tax Act. This one talks about the issue to do with payment of tax, complying with the tax, filing the tax, and so on. So they provide framework on how the company should report their financial statement so that they comply with payment of tax. Let us see. We can say this act regulates. This act regulates. This act regulates how business, how business, or how businesses determines their taxable income, their taxable income, and ensures uh, financial statements financial statements financial statements reflect fair taxation practices. So that's all about the income tax. So this act itself regulates how the business determines their taxable income and ensures that the financial statement reflects the fair taxation practices. So in short, they are there to help in determination of tax liability. Let us see some of the functions. Some of the functions. 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 Now, functions, number one, they define rules for computing business income. They define rules. They define rules of computing business income. You know what's a business income? Business income is income which is subjected to tax. So business income is the income which is subjected to tax. So one of the main function of KRA or sorry of the income tax is provide rules on how to compute the business income, the final business that should be taxed. Number two, it identifies allowable and disallowable expenses. Number B, it identifies allowable and disallowable expenses. Now, allowable expenses are the business expenses which are used to generate revenue for the business. So we talk about allowable expense, which we shall study it in the next level, that is intermediate. So allowable and disallowable. Allowable deductions or allowable expenses are those expenses which are used by the business to generate income, and therefore they are used purposely for the business. Then you have the disallowable deduction or expenses. These are expenses incurred by the business, but they do not help to generate revenue. They do not help to generate revenue. So the income tax help us to differentiate between allowable and disallowable expenses. Number C or number 3, it gives us guidelines on how to prepare the tax or on preparation of tax return. So it provides guidelines. It provides guidelines on how to determine on how to prepare and submit tax return. So they are there to help us. So those the income tax is there to help us how to determine and prepare tax return, and then we can talk about. So we have another two items. Number D, as you can see, the Income Tax Act also provides. It also provides a framework on how to use the audit financial statement to determine tax liability. So they also provide that framework for example, for KRA to use the audited financial statement in order to provide the tax liability or the tax to be paid by the company. So the meaning of the word tax liability is the amount of tax that the company should pay. Then number E or the last one, this Income Tax Act also provides penalties on false and misleading tax information supplied by the company. So if the company supply any information which is misleading or which is false concerning tax, which would affect the final product, the final tax liability, then the income tax provide uh, the penalties in case the company supply any false information. That is number 2, the income tax. Number 3 is the Public Finance Act. Number 3 is the Public Finance Act. Public Finance Act. Let us talk about the Public Finance Act. So number 3, it is the Public Finance Act 2012. Now for the Public Finance Act 2012, now this Public Finance Act governs the public financial management to promote what we call the efficient use of the public resources. So they are purposely there to ensure that the resources are well utilized, the government resources. So we talk about the Public Finance Act. This is about the public now, the government. Now, what are the functions of this act? Functions number 1, which is very important, it requires adoption of IPSAS in public sector accounting. Remember, when we talk about the public account, the public sector uses the IPSAS. They do not use these items. They do not use the IFRS. So remember, IFRS and IAS, they are used in the normal companies, public and private limited companies. But for the government, so the government uses IPSAS as their accounting standards. So remember, we have the public sector, particularly the government, particularly the government uses. So they use what we call the international, we call them international public sector accounting standards. Standards. So remember, the government or the public sector uses the international accounting standards to prepare their finances. So that is the requirement. Then the public and private companies, public and the private companies, the what we call the LTD companies. Now they uses so these people use what we call the International Financial Reporting Standards, the IFRS, International Financial Reporting Standards, the IFRS, and the international accounting standards, the IAS. So these two. So these two mostly they are there for the Company Act. But for the government, they use what we call the IPSAS. They use what we call the IPSAS. And number two, they provide framework for the budget preparation and execution. Remember when we talk about the government, now the biggest work of the government in most scenarios is that they usually provide a lot of budgets. Now, the Public Finance Act, because they are there to guide on how to use the resources, they provide framework on how to prepare budgets and how to execute the budgets. Then they enable accountability through periodic reporting. Periodic reporting is reporting the information from time to time, monthly, quarterly, and so on. So they enable what we call the accountability through periodic reporting of the financial information that relates to the government. Then they also establish the role of the accounting officer and the internal auditors. Remember, accounting officer is the person who oversees the financials of the companies, of the not companies, of the government. And therefore, this Public Finance Act is there to provide the role of the accounting officer, also the internal auditors. So internal auditors, they provide the standards that can be used internally, the controls the company can use, not the government. Why am I using the word company? So internal auditors for the government, they provide the internal controls or the controls that the government can use to safeguard their resources. So it's also the function of the public finance to provide the roles of the internal audit. They also provide what we call the physical reporting and physical transparency. So what is the difference between physical reporting and physical transparency? So what is the difference? Now when we talk about physical responsibility, so when you talk about the physical responsibility refers to the government obligation to manage public finance prudently, efficiently, and sustainability. So you need to know what is the difference between the two. Number one, maybe you can find it somewhere. Can be asked to talk about the responsibility, responsibility, and you can also be asked to talk about uh, physical transparency. Physical responsibility and physical transparency. So we have said refer to the government obligation to manage public finance. So refers to, you can say refers to government's obligations obligation to manage public funds prudently. Refers to the government obligation to manage the public funds prudently, efficiently, and sustainably. Efficiently and sustainably. Then, in case you find something to do with, now when we talk about fiscal responsibility, uh, it's not about balanced budget, accountability, proper use of resources. All those are component of fiscal responsibility. When you have a balanced budget, when you have accountability, resources are well utilized, and so on. It's not about the fiscal responsibility. Now we have the physical transparency. Now we talk about the physical transparency. This is about the openness about public resources. So openness about how public resources are raised, allocated, and used. So refers to openness. So you can say refers to openness of how public resources are raised and distributed. So refers to how openness public resources are raised and distributed. That is all about the two items. We don't need to talk about them so much. Maybe we shall talk about them when we should be talking about public finance. But in this case, we're talking about financial accounting. So just know that when we talk about fiscal responsibility, this is the obligation of the government to manage public fund prudently. Then we talk about the fiscal transparency. This refers to the openness that should be there when it comes to how the public resources are raised, used, and distributed to the citizens. Number four. Number four. The next item is number four. That is KRA, Kenya Revenue Authority, KRA. Number four. So let us see the KRA. So the Kenya Revenue Authority. Now the Kenya Revenue Authority, it enforces the laws regarding the tax, regarding tax. So they are there to enforce what we call the tax laws. So that's number one. So I talk about the Kenya Revenue Authority. This is a body which enforces uh, the law regarding to tax, and also they rely to the audited financial statement for the purpose of assessing tax assessment and compliance. For the purpose of assessing tax assessments and tax compliance. So generally, when we talk about the Kenya Revenue Authority, this is a body that enforces laws regarding to tax, and it relies to the audited financial statement for tax assessment and for tax compliance. So what are some of the functions? So we have the functions here, compressed functions. So I have compressed the functions. Number one, they provide the e-filing system, and also they provide payment tax system. So they provide two items. So this way we can put it into two different points, but said to put it in one point. So number one, e-filing system. So you can easily file your return. So they provide the system where you can file your return, and also they provide the system where you can pay your returns just through the same system. Number two, they use the audited financial records. So KRA uses audited financial records to ensure tax compliance, to ensure tax compliance, or to ensure the company pays the correct amount of tax. Another one, they administer VAT, pay, and other form of taxes. So they administer. So it is a function of KRA to administer VAT, pay, corporate tax, etc. Then they enforce the tax report deadlines. So they come up with deadlines where you need to submit your final report. For example, VAT submitted in this month, every month at this date, and so on. They also provide penalties in case of tax evasion, or penalties in case there is any misconduct when it comes to submission of the return, or submission of the return. So those are some of the function of KRA as a legal source of regulation. Then the last one is the Capital Market Authority. Capital Market Authority. That one will be our last legal source. That will be our last legal source. So let's talk about the Capital Market Authority. Capital Market Authority. Let us finish on the CMA, the Capital Market Authority, CMA. That is our last legal source regulation. So number one, the CMA, or the Capital Market Authority, CMA, it ensures that the listed companies, mostly in the Nairobi Stock Exchange, provide accurate and timely financial information. So that is their main mandate, to ensure that the company issue or discloses their financial information on a timely basis, and to make sure that the information provided is accurate. Now, what are some of the functions? Number one, IFRS compliance. So they ensure that the company complies with the IFRS, or they prepare their financial statement according to the international financial reporting standards. Number two, they approve prospectuses of security offering. So what are the prospectus? So prospectus, those are the legal documents which have details concerning the issue of shares. So they approve those prospectuses, or the prospectus of security offering. So I say that prospectus, these are the legal forms or the legal documents which contains the list of investors with the shares. And then they requires company to provide interim and annual report disclosures. So in short, the CMA requires that the company to provide annual report or the interim report for the company. So what is the interim report? Interim, in case you don't see it clearly, interim. Now, interim report, this is a report issued by companies on or on quarterly basis or semi-annually basis, not annually. So anything that is not annually, or these are the reports which are issued by the company for less than a year, quarterly, monthly. So it can be monthly, quarterly, or semi-annually. But quarterly and semi-annually is most applicable. Then we have the annual report. That is the report for the whole year, for the financial year. So the CMA requires the company to issue interim and annual report disclosures. It also provide investor confidence through transparency. So the CMA makes sure that there is a lot of transparency when it comes to these companies, so as to promote what we call the investors' confidence. And then they investigate sanctions. They investigate and sanctions financial reporting misrepresentation. That is correct. So they investigate and sanction financial misrepresentation. So we talk about sanction. Sanction means fines. So they investigate and fine any financial misreporting or misleading information. So in case they investigate and they find something to do with misrepresentation or fraud, they do what? They sanctions. To sanction is to do what? Is to issue a penalty and so on. So those are some of the five legal sources. So we have five legal sources. So we have the Company Act, we have the Income Tax, we have the Public Finance Act, and then we have here KRA, Kenya Revenue Authority, and then we have the CMA. Now, once we are done with the legal sources of regulation, we go to the next item: professional sources of regulation. Professional sources of regulation. Professional sources of regulations. So let us see the now number two, professional sources of regulation. Professional regulation. Professional sources. Sources of regulation. Let me name them. So we have number one is ISPAC. 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 This is the Institute of Certified Public Accountant. Institute of Certified Public Accountants. Kenya. Number two, you have the IFAC. IFAC, that is the institute. No, this is the International Federation of Accountants. International Federation of Accountants. Then we have what we call the ISB, International Accounting Standard Board. International Accounting Standard Board. International Accounting Standard Board. That is the International Accounting Standard Board. So we have three of them. So we're going to start with the first one, ISPAC. We're going to start with the first one, ISPAC. Then we go to the second one. Then we finish with the third one. So those are the professional sources. So number one, as I said, is ISPAC. Now, ISPAC is a national regulatory body in Kenya which regulates all the CPAs or the certified public accountants in Kenya. Now, they oversee the accounting profession in Kenya. So, what are some of their functions? Number one, they register and license practicing accountants. For example, the audit firms. So, the audit firms are registered and licensed by the ISPAC. Number two, they provide the CPD uh, uh, programs for what purposes? For development purposes. For development purposes. They also ensure that there is an adherence to the IFRS and the ethical codes. So that's another function to ensure that there is an adherence when it comes to the use of the financial reporting standards, and also when it comes to the ethical codes. Another one, they investigate any misconduct which is done by any person who is registered under what? Under the accounting profession, especially with this part. And then they also advises the government and stakeholders on accounting reforms. So they give uh, advices to the government or to other accounting professions or to any field when it comes to any new reforms regarding uh, accounting reforms. Now, for CPD, when we talk about CPD, CPD means continuing professional development. Continuing. So we talk about CPD, we are talking about continuing professional development, CPD. So in case you don't know that one, that's the CPD. So these are the continuous assessment that the institute provide to the member, either at a fee or sometimes on a free basis. So those CPD or those continuous program are there to enhance or to to help the members to get more insight on what is happening, the current trend, the new insight, the anything that it is new to the members to continue learning. Then we talk about IFAC, the International Federation of Accountants. Now, this is a group organization that sets the standards and provide guidelines for the accounting profession globally. So the IFAC, it's a global organization which governs all the other bodies. So, for example, IFAC governs ISPAC. So ISPAC is under the wings of the IFAC. IFAC as the global organization, then ISPAC and other members. So each country has their own representative. So, for example, in Kenya, ISPAC is a member under IFAC representing Kenya. So if you go to Rwanda, we have the Institute of Certified Public Accountants of Rwanda. If you go to Tanzania, we have the Institute of Certified Public Accountant of Tanzania, and so on. So all those bodies are regulated by the IFAC. Now, they issue the international codes of ethics for professional accountants. So that is their main role, to issue international code of ethics. Number two, to promote high quality accounting standards, the IFRS, international financial reporting standards. So they are there to make sure that the IFRS are of high quality and standards required. They also support the professional developments, uh, either through CPD or any other way. It can be either through CPD, because CPD, they are there personally to assist when it comes to continuous career development and training of members. So they support also professional development of the members, the ISPAC and their members. They also facilitate convergency of IIS, so they make sure that the IIS integrate. Even if we use the IIS in Kenya or in United States or in any other place, the same IIS will converge. Uh, and then they encourage what we call the ethical and transparency practices globally. So that's their other main agenda or function. So they ensure that there is what we call the ethical practice and transparency globally. Then we have this last body, IASB. So that is the International Accounting Standard Board, and it is a body responsible for developing and issuing IFRS. So this is a body responsible. This one, the it's a global organization that sets standards and provide guidance. This one they develop now, so they develop, and then this one they make sure that the standards developed, they meet the quality required. So International Accounting Standard Board, they are there just develop and issue FRS. Their function number one, they conduct and maintain. This pen of mine doesn't have an ink, but we say they conduct and maintain IFRS. Number two, they conduct stakeholder consultation and public exposure draft. So this is public participation, but remember it's a global body. So they go to various countries to do those items, but they do it through their members. So they can do through their members. Then they update standard to reflect the economic changes. So they make sure that the accounting standard available, they meet the economic environment. And then they issue the FRS interpretation. So they issue guidance through the IFRS Interpretation Committee. Then they promote consistent financial reporting across jurisdictions. So across the jurisdiction kumaanisha across countries. So they promote consistency to make sure that the standards used in Kenya is the same standards that is used in Nigeria, or the same standard that is used in South Africa, so as to allow consistency when it comes to preparation of the financial statement. So they also make sure that there is consistency from various jurisdictions or from various countries to make sure that the IFRS used, they are consistent. They are consistent from one country to another. Now, let us talk about the accounting policies, the accounting standards now, as subtopic as accounting standards. So we shall define what is accounting standard and give their function. Then we give examples of the accounting standards and we explain them. For example, the IFRS, the IAS, and the IPSAS. So let us talk about the accounting standards. Let us talk about the accounting standards. So when we talk about the accounting standards, as you can see in my board, accounting standards, these are the authoritative statements from the word authority. These are authoritative statement that gives guidance on accounting treatment and presentation. So in short, when we talk about the accounting standards, these are the statements, these are the authoritative statements that guides how the financial statement should be prepared and presented. So and what are some of the treatment of these items that affect the financial information or the financial accounts. Now, a good example of accounting standard is IAS 2, inventory. So I is to talk about the inventory, just an example. Then we have the IFRS 9, talk about the financial, it talk about how the treatment of the financial instrument. Now, what are some of the functions of the accounting standard? Number one, it promotes uniformity and consistency when it comes to the financial reporting. So they ensure that each company prepares the statements according to IS, meaning at the end of the day, the presentation of the statement of one company and the presentation of the statement of another company will have what we call consistency, meaning you can easily compare the two. So to allow consistency. Number two, comparability. Just same as the first one. So it enhances comparability of the financial statement across different companies or entities. Number three, these accounting standards promote what we call the credibility and reliability of the financial information. Meaning, if the information have been generated or they have used the standards to come up with the statements, it means that a person can rely to that information because they follow guidelines that are required to be followed. They also facilitate decision making. This one is for the users. Remember the users. So the users of this information rely to this information to make decision. So the users can only relate to this information if the information has been presented according to the accounting standards. Number four, they provide basis for auditing and regulatory enforcement. So they provide basis for audit and regulatory enforcement. In short, when an auditor wants to audit the financial statement, one of the things that this person will look during auditing of the financial statement, has the company followed the guidelines according to the accounting standards? So they provide framework or they provide basis for auditing. Now, what are some of the type of the accounting standards? So we have the common ones here, the IFRS, the International Financial Reporting Standards, the normal one for companies. Then you have the IFRS for SMEs, small and medium enterprises. Then we have the IPSAS. Then we have another one here, the International Accounting Standards, IAS. So International Accounting Standards. And remember, IFRS means International Financial Reporting Standards. International Financial Reporting Standards. So that is IFRS. Then we have International Accounting Standards, that is IS. Accounting Standards, that is IS. Then we have International Public Sector Accounting Standard. International Public Sector, Public Sector, Public Sector Accounting Standards. Accounting Standards. So remember, we have those three different. Now let's start with the IFRS, the International Financial Reporting, and International Financial Reporting for SMEs. Now let's define what is IFRS. Now IFRS is a globally recognized set of accounting standards which is developed by International Accounting Standard Board and adopted by many research firms in various stock. I.e. example, let's give an example of the international ISO. So for example, we have the IFRS 9. For example, the IFRS 9 financial instrument is a good example of a set of accounting standard. Then you have the IPSAS, International Public Sector Accounting Standard, and we say it is a set of accounting standard developed for the public entities, particularly and the word particularly the government, particularly the government. So example, let us look at an example of the IPSAS. You can have what we call let me see if we can find one. We can have just a moment. Just a moment. So remember, IPSAS is also an accounting standard, a set of accounting standards that is used purposely for the public sector. Now, a good example is IPSAS 17 PPE. IPSAS 17 example, we can talk about IE IPSAS 17. That is property, plant, and equipment. Property, plant, and equipment. And equipment. Now remember, if we were to talk about accounting standard, we can add another example here. And IS 16. Now IS 16 is about so we talk about IS 16 is about property, plant, and equipment. This